Yeah, I mean, we're all over it. Last month, April collections, we were at 98%. So far for May, as of the 15th of May, we were at over 100% collections of March's collection. So we're doing fine in that regard, but we're also very aggressive. The state of Texas, or actually the city of Houston rolled out its own renter relief program. All of our properties were enrolled within 30 minutes of it rolling out, just in case the funds ran out. So we are very aggressive, constantly with our ear to the ground, seeing what incentives come out, because that's really what's propping up a lot of this. We had this kind of artificial uplift in collections due to a lot of these rental assistance, charities, stimulus. So it's really challenging to determine what is the real situation in multifamily, how much of these collections are real dollars and how much these collections are non-W-2 dollars.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. Today we have a goodie. We have a really good real estate investor out in Texas. We're going to get deep down and get some details. First, before all of the fans and listeners of the show, make sure to like, share, and subscribe. The show notes, more information about the guests will be on our website, passiveinvestorsclub.com. We're also giving away a free ebook, Real Estate Mailbox Money. You can go there at passiveinvestorsclub.com/book. Our guest today, Joseph Bramante, CEO of Tri-Arc Real Estate Partners out in Texas. They're a multifamily real estate investment firm with multiple units. We're going to get a lot of great information for you guys. But first, Joseph, thank you for joining us on the show. And how you doing, my friend?
Hey, Dwayne. Doing well. Thanks for having me.
Absolutely. Really appreciate it. Taking the time. I know it took a couple of weeks for us to schedule because, like I said, you guys have a really busy schedule. You guys working on a lot of big things out there. But before we kick things off, would you mind telling us a little bit about your backstory and how you got started in real estate?
Yeah. So I was a former W-2 employee, engineer by trade, went to work for Exxon right out of college. Did that for about 5 years, traveled overseas for them, spent 3 or 4 years, it's about 3.5 years in Australia and Papua New Guinea, mostly in Papua New Guinea, working on a $22 billion project, of which about $1 billion of the cost I managed. Was based there, lived there for 2 years, had zero expenses and a lot of money, and used that initial money to purchase a small apartment complex, sight unseen, read a few books, and felt qualified enough to go ahead and buy this property. This was 2011. And, fast forward 6 months into my first acquisition, we found out that the property has asbestos. We're 4 units in that we can no longer touch because of the asbestos. We have fraudulent insurance, so we don't have insurance. And I no longer have my job at Exxon. So it was just, 6 months into multifamily, it was really bad, completely different situation for me versus when I started. And that was kind of my baptism by fire into multifamily, because I was either going to lose this asset, which I had, was now negative cash flowing, and I invested the majority of what I'd made for the last 5 years while working for Exxon into it, or I was going to turn the whole thing around or at least, salvage my investment. The whole goal was don't lose money. It wasn't really trying to make any profit at that point. It was just get out of this thing in one piece, live to tell another day. Well, we ended up knocking out of the park on that first one, me and my partner. We did this massive 30,000 per door renovation on our first deal, when many of our mentors and advisors were advising us to do the opposite. It was very unheard of back then, especially from a first-time operator, to go ahead and do such a big rehab, and let alone be successful at it. So we despite a lot of just stubbornness and not wanting to lose, the only other thing that we had in our court was that the location was just in a superb location in Houston, and that was really what allowed us to do such a big rehab. Fast forward 2.5 years later, we're refinancing that property, 200%, 207% return, and then use that as the kind of our flag in the ground, so to speak, to raise capital for future deals. And ever since then, our niche has been these heavy value adds. As we speak, we're doing a 37,000 per door renovation and going to be producing a pretty big windfall to our investors on that deal. And so that was kind of, got the start in heavy value add, continued forward in heavy value add, currently doing heavy value add. And that's where we like it. We feel, as risky as it is, we feel the safest doing the big value add because it's forced appreciation. And for a while in the market, operators have been able to just kind of ride this cap rate compression wave. But now we know cap rate compression is basically over. And if anything, we're looking at some expansion. And the only opportunity that an operator has to outrun expansion, if you can really call that, because in reality, you'll never outpace expanding cap rate, but you can at least, you can at least fend against it the best you can with a heavy value add. So that's what we did. We did probably 6 more deals, officially formed a partnership with my 2 operating partners in 2016. And then we've really just kind of taken off. It's been 2 years kind of getting the processes down. We're trying to, our objective has been to form a company that's really in it for the long haul, not really just trying to stack properties on top of each other. We're really trying to build something great here. And so for us, we took the time. We wanted to get the processes and the structure down right. And then also we were just also monitoring the pricing and whatnot. It's been a very tough market. We're very selective in what properties we buy. And then in 2018, we made the decision to expand our offering to not only include syndication, but to include property management. So we will now fee manage deals for other people. And then at the beginning of this year, we expanded that offering again to include construction management. So we brought in-house our GC. And so we're doing our own construction for our own projects. We're also doing renovations for others because we have that, we have that expertise. A lot of people want to do value add, and they can get as far as getting pretty accurate on the scope, but afterwards, from the whole execution of it, things tend to fall apart, has been our experience. And that's kind of where we shine, especially by having operations and construction and the ownership management side all in under one roof. So
yeah, I like that a lot. Because I only probably spoke with a handful of hands-on operators, because there's a lot of people that are flocking to Texas for all of the obvious benefits of just a booming economy down there. But a lot of people are not willing to touch these very heavy value add type of deals for obvious reasons. Especially if they're an outside investor, they're not sure construction costs, executing it, and then they're dealing with time frames and stuff. So they're usually looking for these easy cosmetical type of value adds so they can kind of get their investors involved into the deal, have it cash flowing immediately, and then everyone be happy. But you guys are kind of take it to the next level, touching deals that probably some investors not really looking forward to it. So that's very good to talk to, and probably can learn a little bit more about that. So you guys are exclusively focused on Texas. Is it the Houston submarket, or is there any other markets that you guys are specializing in?
Primarily Houston. We also look at Corpus and everything in between Houston and Corpus. That's just where we have our expertise. My 2 partners have been in property management for the last 30 years, specifically here in Houston. And between the 2 of them, they've managed over 43,000 units and about 1.7 billion in assets. So it's anytime we start going outside of that, we start losing our competitive advantage. And this is a very risky industry, just inherently risky. We don't like to lose our advantage.
And then, so as far as kind of I know I ask all of the guests now, especially it's the biggest topic is, the COVID-19. As far as how you guys, are your investment criteria has changed since then? Are you guys looking at deals a little bit differently? I know I talked to a couple sponsors, a couple syndicators, some of them are holding back. Some of them are just looking at it, a little bit more sensitive because you have to add in the financing, situation and how you can be able to finance it properly. How are you guys looking at deals and what's your current situation on, looking at properties?
Yeah, well, a lot of these deals are being price adjusted based on the lending terms that are currently out there. It's really outside of our control as operators to go ahead and pay even the price we wanted to, because it's just math. The numbers don't work anymore when you're putting 12 months of principal, interest, insurance, taxes, and capital reserves, paying that all up front on these deals. Those can be real deal killers, especially when you get to these bigger deals that it adds up to millions and millions of dollars.
Hmm. And as far as kind of like your target, I know you guys go to deep, heavy value add. Is there kind of like an average like hold time that you guys like kind of your original game plan to say like we're gonna raise money, buy a deal, hold it for 5 to 7? Is that kind of what you guys do as well? And does it change now since kind of the climate is different, and then we know that the market's gonna kind of shift in the next couple months?
It's changing a little bit in that we're looking at some 10-year debt with fixed interest because rates are very low. You can get some really great Fannie debt right now, and that'll help you keep your competitiveness on the pricing, because obviously the sellers, they want to command maximum price, and they're always going to want to command maximum price, whether it's a good market or bad market. And we're buyers, we're trying to buy properties that make sense for us and make sure that we've got enough of the kind of safety nets built in for us that if things, if the second shoe drops, that we feel comfortable closing on a deal. So we are underwriting them slightly differently, more so on the terms, also less aggressive on the interest, on the rental growth rates. But then also we are contracting them differently and putting in different terms into the contract so that if a second shoe drops regarding to this COVID situation during our contract, then we would have some outs in that contract.
How are you guys looking at? Do you see a significant change in the deal flow that's available out there since this pandemic? More or less type of deals, and where you kind of see it going into the future next couple months?
Yeah, well, any seller who can afford to wait is going to wait until this blows over. And so really the deals that do come to market are going to be the ones from the sellers that can't afford to wait. And so if you're a buyer, that should be very interesting for you.
Mm. And then you guys being boots on the ground, also handling the property management. How are you guys handling the obstacles, obviously, with people losing their jobs and things like that? Is there stuff, I know with the property management, there's a lot of stuff they're getting, forbearances and some state mandated things regarding to rent. How are you guys as a property management company handling that?
Yeah, I mean, we're all over it. Last month, April collections, we were at 98%. So far for May, as of the 15th of May, we were at over 100% collections of March's collections. So we're doing fine in that regard, but we're also very aggressive. The state of Texas, or actually the city of Houston rolled out its own renter relief program. All of our properties were enrolled within 30 minutes of it rolling out, just in case the funds ran out. So we are very aggressive, constantly with our ear to the ground, seeing what incentives come out, because that's really what's propping up a lot of this. We have this kind of artificial uplift in collections due to a lot of these rental assistance, charities, stimulus. So it's really challenging to determine what is the real situation in multifamily, how much of these collections are real dollars and how much of these collections are non-W-2 dollars.
Mm-hmm. Yeah, and plus we're seeing now lately with the state of Texas, kind of getting I won't say aggressive, but looking forward to opening up the the economies and like that. So it seemed like is it Greg Abbott, the governor? It seemed like he's he's on top of the ball of trying to stimulate, because Texas is one of the the country's top economies, so they need to really get things rolling. the PPP program, getting, because I deal a lot in single tenants, so I'm talking to a lot of tenants and my clients and stuff, and making sure they're getting onto the program so they can make sure to get their employees back working, get things moving while they slowly lift all these restrictions. So it's good that you guys been on top of that. Moving over to the topic of investors, of course, people listening onto this call, your investors that are invested into your deals, communication is like the number one thing, especially during this time where, depending on what news channel, you can be very scared to be like, okay, we're going to get through this. How's your communication to your investors, and can you kind of talk about the importance of that?
Absolutely. Communication, particularly in that first month, when this thing first hit us, we were communicating with them on a weekly basis, letting them know, hey, this is where we're at. This is the collections. Everything's okay. We actually haven't communicated them directly with them as of May yet, just because we've got really great systems in place. They've all got access to the properties 24/7. So anytime they want to see how the property is performing, they've got access to weekly reports that allow them to see in real time, or at least within 7 days of each other, how the collections are performing, what the occupancy is, et cetera. So on May, we kind of slacked off a little bit just because we knocked out of the park in April, and we're doing even better in May. But I agree. If you don't have those kind of things in place already for your investors to autonomously just kind of go in and check out for themselves, communication is absolutely the most important. And we deal with this a lot when we're in hurricane season, or we have other kind of natural disasters in Houston where you just got to be communicating in real time, because there's a lot of things going around, and they're also dealing with it as well. People forget that it's not just us; they're dealing with their own COVID issues, and so we got to be sensitive to the fact that we're not giving them COVID overload and just creating more info than they need. When they're dealing with, most of my investors are business owners. They've got they're very successful in their own right, and so with all that success comes a lot of responsibility. So they're dealing with their own issues in regards to COVID, and so we try to keep it need to know, as far as not overloading them with every little thing regarding COVID.
Yeah, that's a good point, because I have my business partner, and a lot of our friends are business owners, and they're also applying for the Paycheck Protection Program, and they're making sure everything, checking on their stores and stuff like that. So they're quite busy, and then their local government's also sending them communication, letting them know, and they're trying to keep up with any changes to the mandate. So of course, keeping them informed, but also kind of not overloading them. But also, you guys are handling business, which is good. And one thing I like about you guys handle the construction management, the property management. So you guys are literally boots on the ground. So your data is so up to date that you can be able to send to them, so they know when they're getting that information that it's pretty accurate compared to a person that has asset management. Yeah, exactly.
Construction's a bit down, because even though construction is an essential service, we don't see a lot of operators really doing anything. Everybody is kind of a wait and see, and that's what it's one of the I don't want to say advantages, but just one of the additional bits of information that I get access to is I can see how the property management side of the industry is doing, how the construction side of the industry is doing, how the ownership side is doing. And so it really helps me form just a complete picture of what's going on in the industry, at least our local market with multifamily. And what we're seeing from the construction side is there's just not a lot of activity, which tells me that operators are sitting on their cash. They're not doing anything. Nobody's doing renovations at the moment. So it's all kind of a wait and see at the moment.
Okay, just kind of keying off of that, like a wait and see, like what your firm's looking at towards the future. You guys just continue looking to expand in Houston, obviously, when things kind of get back to normal. And then, like I said, and then do you guys do 100+ units and stuff like that? Or you guys do what type of unit class and things like that?
I'm sorry, what was the first part of the question?
Yeah, so were you guys looking towards the future as far as kind of your
Gotcha.
company and things like that? Yeah.
Yeah, so for us, we've got pretty audacious goals. We're trying to get to 20,000 units by 2030. So we've got a long way to go. We're at just over 1,100 now and climbing. We're also venturing into the new development space. We've got a 30 unit phase one breaking ground later this year, and it's total of 500 units. And then we've got 2 other mid-rises that are going to be breaking ground in 2023, and those are very preliminary, but they're roughly 300 units each. So we've got a lot of new development stuff that we're kind of dipping our toe into, and but then sticking to the acquisitions as our bread and butter, getting up to 20,000 units, maybe going outside of state lines, and looking into other territories. But again, Texas, I mean, just in Houston, you got over 2,300 apartment complexes, and that's just Houston. So we don't even look at Dallas and Austin and San Antonio.
Yeah, plenty for you to work with out there. I could tell you that. So awesome. That's good to hear that. So what's kind of like a typical work day for you? And do you have any special morning routines?
For me, typical work day is, today was probably the first time I've been back to typical since COVID started, because our gym opened up. So I was able to get my 5 a.m. workout in, and
Nice.
Man, it feels great to get that, kind of get that anchor of my day, get that done. So that's my typical days. I wake up in the morning, go do my workout, respond to a few emails, get into the office. And, I've got an assistant who keeps my schedule pretty stacked. And so like today, I don't get a break until 4:00. So it's just typically meetings after meetings, calls. In the evenings, it's kind of my time to get some work done. And I'll usually do some underwriting towards later in the week. But typically it kind of unwinding around 8:00 or so, then going to bed and starting all over again. So
Exactly.
that's kind of my routine. I enjoy it. I like I like to stay busy, and I like that what we're working on, multifamily has its own kind of rhythm, own cadence to it. And you can, depending on where you're at, if you're under contract, that's a different cadence you're going to. Obviously a much faster cadence. If you're doing new development like we are, it's a much slower cadence. And if you're just doing regular stuff, it's your normal cadence, that's going to be somewhere in between those two. So we're, just kind of measuring the cadence and keeping up, and trying to make sure that we're going at a rate that's fast enough to hit our goals.
Absolutely. I know a lot of us are, been home, especially during the lockdown, and just give people to kind of think and, appreciate the things. For me, I got my family that stays here with my wife and stuff. So I have a lot of gratitude for that, everyone's healthy and stuff. But, for you, what do you say that you're most grateful for?
Yeah, family as well. I'm just like you. We've really gotten in touch with a lot of our family. I feel like this whole thing brought everybody closer together. You realize who's really vulnerable, and you start to, unfortunately, you imagine a world without them. You think, man, if something happens, my parents, my grandparents, whoever is at risk, and then you for a brief moment you think of what your life might be like without them, and it's not good. So for me, I've taken the time I've got scheduled time with my grandparents and aunts and uncles at a certain day of every week, and because I'm just busy, and I found that for me personally, I have to schedule it in, otherwise it just flies by, and next thing you know, I realize, oh man, I was like over a month since last time I talked to you. So that's what I've gotten good at with this whole COVID thing, is making sure I'm making time for family and getting in touch. And it's great. I really enjoy, I think just last week I spoke with my grandparents for almost 2 hours, and we just talked, and it was good to catch up and, get their perspective on it. And I mean, if you've got grandparents out there, I mean, my grandparents are in, nursing home, and they're okay and all, but they are miserable because it's complete lockdown, and just imagine living in your bedroom for this whole time. That's what it's like for them. So it's rough out there. So give your grandparents a call if you're listening to this.
Yeah, I like that tip. I actually do the same thing. It's just like, if I don't put it into like my schedule or database, like I get a little pop-up say, call grandma, and, just to put it in there. So if you get anything from this call, just, put into your schedule or put into a routine where it's like you just call and just make it a habit. And like I said, especially at this time where people, loved ones, you're just thinking about them, you never know. So you make sure to make that phone call. So I appreciate you giving us that tip. So this great interview. It was great hearing your story and development of your company.
I'll give you one other tip. This is something I do, and you guys can do if you want, but I've got a little app on my phone that automatically records every conversation that I have with my grandparents, just because I don't get to see them that often. And tell you what, when they're gone, I had lost a grandpa I lost my first grandfather when I was a child, and I tell you what, I would just love to hear his voice right now. And so it's really nice to, I can always go back and have those recordings of them. So anyway, nothing to do with business, but we were there, so I figured I'd throw in that little tip.
Yeah, I like that. You said it was an app that you used. Do you remember the name
I've
of that?
got an app. I'll send it to you after this.
Cool. Yeah, we'll throw it on the sheet there and make sure to throw it into the show notes.
It automatically records. I don't have to do anything. It just recognizes that there's a call between me and my grandpa happening, and it just starts recording.
Wow, I like that a lot. Yeah, that's very cool. So awesome. Yeah, I really appreciate you sharing that. So we're going to have your information in show notes, but can you share with us what you're willing to share as far as your contact information?
Yeah, sure. I'm pretty active on LinkedIn, so just check me out there. And from LinkedIn, there's a lot of links under the contact info for our website. There's a calendar, so if you want to schedule a call with me, you're welcome to do so. And then if you're interested in even joining our mailing list, there's an option for you to do that as well. Our new website, we just updated the website. It looks amazing. I really hope you guys go and check it out. We spent a lot of time and thought went into this. And we're, just a ton of content just about the different companies. We've got 3 companies that we had to address. So it's a lot of thought went into this with all parties. So go check it out, see what we're about. And then also, if you want to send me an email, you can send it to info@triarcrep.com.
And that's TRIARC, rep.com. And if you're looking them up on LinkedIn, Joseph, Joseph, and then Bramante, Bramante.
Yeah, you'd be surprised. I always get this misspelling of Joeseph, and I've still to this day never met somebody with their name's Joseph spelled that way. I don't know how my name always gets spelled like that.
You're unique man.
Yeah.
Awesome. But yeah, Joseph, it was a pleasure speaking with you and connecting with you. I love getting some insights for the audience here. And like I said, again, reach out to him, check him out on LinkedIn, and have a conversation. But Joseph, stay safe down there, continued success. And I look forward to connecting with you again soon.
All right. Thanks, Dwaine.
All right. Take care. You too.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.